Welcome to this essential chapter on special commercial laws. In our journey so far, we have explored the fundamental building blocks of business. We have understood how companies are formed and the general rules that guide their conduct. Now, we must delve deeper into the specific laws that govern the very pulse of daily business operations. Think of these laws not as restrictions, but as the traffic signals and signposts on the vast motorway of commerce. They ensure that everything moves smoothly, safely, and predictably. Without them, the world of trade would be chaotic, inefficient, and fraught with unnecessary risk, making growth nearly impossible. These specialized regulations are the invisible architecture supporting every transaction you see. Every time a product moves from a factory to a warehouse, there is a law governing its journey. Every time a business acquires a new machine to increase its production, there is a legal framework that facilitates this acquisition. And with every single sale or purchase, a comprehensive tax system is at play, ensuring fairness and contributing to national development. This chapter is designed to illuminate these critical areas, transforming complex legal jargon into simple, actionable knowledge that you can apply directly in your business life. This chapter will act as your guide to three pivotal domains of commercial law. First, we will navigate the intricate world of the carriage of goods. This is the lifeblood of logistics and supply chain management, an area that ensures your products reach your customers effectively and securely. We will break down the rules that protect both the sender and the transporter. Understanding these rules is fundamental for anyone involved in buying, selling, or moving physical products. It is the first step towards mastering the physical flow of your business and managing the inherent risks involved in transit. Next, we will turn our attention to the strategic tool of hire purchase agreements. For many growing businesses, especially small and medium-sized enterprises, acquiring essential assets can be a significant financial hurdle. Hire purchase offers a powerful solution, allowing businesses to use vital equipment while paying for it over time. We will explain how these agreements work, what makes them different from other forms of financing like loans or leases, and how you can leverage them to fuel your company's expansion without draining your capital. This knowledge empowers you to make smarter financial decisions for long-term success. To understand the law of carriage, we must first learn about the central figure, the carrier. A carrier is any person or company that undertakes to transport goods from one place to another for a price. However, the law makes a very important distinction between two types of carriers. These are the common carrier and the private carrier. This difference is not just a matter of terminology, it fundamentally changes the level of responsibility and the legal duties that the carrier owes to the person sending the goods. Understanding this distinction is the first step in protecting your business interests when you hand over your valuable products for transport. A common carrier is a business that holds itself out to the public as being ready to carry goods for anyone who wishes to hire them. Think of a large logistics company, the Indian Railways, or a public transport service. They have a public duty. They cannot pick and choose their customers without a valid reason. If you approach them with goods that they are equipped to carry, and you are willing to pay their standard charges, they must accept your consignment. This public obligation is a key feature. They are in the business of transportation for everyone, not just for specific clients under special contracts. On the other hand, a private carrier does not offer their services to the general public. Instead, they work on a case-by-case basis through individual agreements. A private carrier reserves the right to accept or refuse any offer to carry goods. For example, a local van owner who agrees to transport furniture for a specific shop, or a company that uses its own fleet of trucks to deliver only its own products, would be considered a private carrier. Their relationship with the consignor is governed purely by the terms of the specific contract they sign for that particular job, not by a broader public duty. The most critical difference lies in the level of liability. The law places an exceptionally high standard of responsibility on a common carrier. They are considered an insurer of the goods. This means they are held to a standard of strict liability. If the goods are lost, damaged, or destroyed while in their care, the common carrier is automatically responsible for the loss. They are liable even if they were not negligent. A A private carrier, however, is only liable if it can be proven that the loss or damage was caused by their negligence. This makes the choice of carrier a crucial risk management decision for any business. When goods move across the country by truck or lorry, their journey is governed by a specific law. This law is the Carriage by Road Act, 2007. A key requirement under this act is the mandatory registration of every common carrier. No person can engage in the business of road transport without obtaining a certificate of registration. For a business manager, this is a vital checkpoint. Before handing over a shipment, you must verify that the transport company is registered under this act. The most important document in road carriage is the consignment note, often called a lorry receipt or LR. This document is a powerful piece of evidence. The consignor must ensure that all details on the LR, such as the description, quantity, and value of the goods, are accurate and complete. The transportation of goods by rail is governed by the Railways Act, 1989. The Railway Administration is held responsible for the loss, destruction, damage, or non-delivery of goods. The primary document is the railway receipt, or RR. Most importantly, the railway receipt is considered a document of title to the goods. The carriage of goods by sea is primarily governed by the Carriage of Goods by Sea Act, 1925. The cornerstone document is the Bill of Lading. This document performs three critical functions. It is a formal receipt, evidence of the contract, and most importantly, it is a document of title to the goods. For the modern world of air freight, the governing law is the Carriage by Air Act, 1972. The key document is the Airway Bill, or AWB. Unlike a bill of lading, an airway bill is not a negotiable document of title. It is simply a contract for transportation. A hire purchase agreement is a clever financial tool that allows a business or an individual to acquire and use a high-value asset without paying the full price immediately. It is a special type of contract that brilliantly combines elements of both hiring and selling. The core principle is the separation of possession and ownership. The hirer gets immediate possession, but legal ownership remains with the owner. This ownership only transfers to the hirer after all the agreed-upon installments have been fully paid. The most unique feature is the option to purchase. At the end of the term, the hirer has the option, but not the obligation, to buy the asset. It is very important to understand that a hire purchase agreement is not the same as a credit sale. In a credit sale, ownership of the goods passes to the buyer the moment the contract is signed. Another financial product, often confused with hire purchase, is a lease agreement. A standard lease is purely a contract of hire with no option to purchase. Let's take an example. A business wants a van costing Rs 10 lakhs. It pays a down payment of Rs 2 lakhs and agrees to pay the rest in 36 monthly installments. The finance company retains ownership. If the business defaults on payments, the finance company has the right to repossess the van. Hire purchase is a strategic financing tool, especially for SMEs. It allows a business to use a productive asset and generate revenue from it while paying for it over time. The Goods and Services Tax, universally known as GST, represents the most profound transformation of India's indirect tax structure in its history. A fundamental concept of GST is that it is a destination-based tax. This means the tax revenue is collected by the state where the goods or services are finally consumed. To manage the federal structure, GST operates on a dual GST model. Both the center, CGST, and the states, SGST, levy the tax simultaneously on intrastate supplies. For transactions between two different states, a single tax called Integrated GST or IGST is levied by the central government. The true genius of GST is the concept of input tax credit, or ITC. This is the mechanism that prevents the cascading effect of taxes, or tax on tax. Let's understand this. A furniture maker buys wood and pays Rs 500 GST. This is their input tax. They then sell a table and collect Rs 750 GST. This is their output tax. When paying taxes, they can claim the Rs 500 as ITC. So, they will only pay the difference, 750 minus 500, which is 250 rupees. For businesses, ITC is critical for managing working capital. It frees up cash that can be used for other essential business activities. Navigating GST requires adherence to 3 pillars of compliance. The first is GST registration, which provides the business with a unique GST-in. The second pillar is the tax invoice. This is the most important document, essential for the recipient to claim their input tax credit. The third pillar is filing returns. GSTR1 details all your sales, while GSTR3B is a monthly summary return used to calculate and pay the final tax liability. Within the GST framework, the e-way bill system is a critical mechanism for monitoring the movement of goods across India. It is a mandatory digital document required for any consignment where the value exceeds 50,000 rupees, replacing the old patchwork of state permits. Its primary purpose is to prevent tax evasion by creating a digital trail, allowing authorities to verify the legitimacy of a consignment at any point. The e-way bill is generated online through the official portal. The responsibility for generation can lie with the registered consignor, the consignee, or the transporter. Once generated, the bill has a limited validity period, which is linked to the distance of travel, typically 1 day for every 200 kilometers. Failure to generate an e-way bill can have severe consequences, including detention of the vehicle, seizure of goods, and substantial penalties. As we conclude, it's clear these laws are the essential legal gears that must mesh perfectly for the engine of your business to run smoothly. Proactive and thorough compliance is not a burden, it is a powerful source of competitive advantage. A business that has mastered its legal obligations operates with greater efficiency, faces fewer disruptions, and builds a stronger reputation for reliability. In the interconnected world of GST, the compliance level of your vendor directly impacts your own profitability, making due diligence more important than ever. By embracing these laws not as obstacles but as enablers, you position your business to thrive, navigating the complexities of commerce with confidence and strategic foresight. This is the true key to unlocking sustained success and becoming a leader in your industry.